Okay, what we learned so far from chapter one, overview of corporate finance reporting. What we found out here is why we're preparing financial reporting for financial statements. We're preparing financial statements for the users of the financial statements, which are the users of financial statements. Those are the investors, creditors, and management. Management doesn't rely too much on the financial statements. We're going to see in the second part of the course what kind of reports the management relied on. When we're preparing statements, we have to keep in mind all the stakeholders or all the readers of the financial statements. Which are the financial statements that we're preparing? We're preparing 5 financial statements. Which are those? Statement of income is always first. Statement of changes in equity is always second. Statement of financial position is the third. Statement of cash flows is fourth. And notes to financial statements is the fifth. How we get the income? Very simple. Revenue minus expenses. That's how you calculate income. Revenue minus expenses. It's going to give you net income or profit or net loss. Those are the two options that you have. Then we have to prepare a statement of changes in equity to see how much the owners invested or the shareholders invested and how much of the net income which company generated is still in the company. Retained earnings represents the position or the remaining net income in the company over the life of the company. Next statement is the statement of financial position. That's where we're going to see what's the assets, what are the assets, what are the liabilities, and repeat what the shareholders' equity is in the company. Assets, those are economic resources which are controlled by the company, help the company to take benefits in forms of sales and generate revenue. Those are the examples. We have two types of assets. We have short-term assets and we have a long-term assets. Liabilities. Liability presents a current obligation which require future payments or sacrifices of economic resources for something that happened in the past. And we have two types of liability, same thing with the assets, short-term liability and long-term liability. Assets are always equal to liability and equity. Always keep in mind, assets are always equal to liability and shareholders' equity. So whatever you have as assets came from investments from the shareholders or borrowings from the creditors. What's the equity? Equity is the net assets. What's the net assets? Net assets from the same equation is assets minus liability. With all the assets that you have, when you close the outstanding liability, if there's anything left in the assets that belongs to the shareholders, that's their net assets. Retained earnings then. What's the retained earnings? Retained earnings again, that's the net income that remain or retain, that's why it's called retained, company earned it and then kept it in the organization. So the retained earnings has opening balance, then we adding the net income, and then deducting the dividend declared. So every time when there's a dividend, that's going to reduce the retained earnings. So from where we're getting the dividend, if the shareholders wants the dividend, from where we're going to get it from the retained earnings. Then we have statement of cash flow, which have three sections. One section is the operating activity, which is the most important. Then we have statement of cash flow, statement of cash flow from the investing activities, and the third section is cash flow from the financing activity. The last one is the notes to financial statements. So what you have to know from this chapter, how to calculate net income, and always remember, the net income is only revenue minus expenses, nothing else. And how to calculate retained earnings. Those are the two important things. Retained earnings, it's always going to be retained earnings at the beginning, plus the net income minus the dividend is going to give you the retained earnings. So if it's the first year of operation of the company, retained earnings is going to be zero. If it's the second year of operation, there has to be something opening balance of the retained earnings. Keep that in mind. Those are the two calculations that you need to know from this chapter. And the name of the financial statements, obviously. So that's chapter 1. Let's move to chapter 2. On chapter 2, if you remember what we did there, last time we did some journal entries. Actually, you become accountants. Here we start recording the events. First, we saw that what's the idea of preparation of the financial statements, what's behind, what's sitting on the foundation, who set up the rules, for which company, what kind of rules we have to follow. So basically, for the public companies, the one that stock shares are traded on the stock market, those follow international financial reporting standards. And for the private companies, they can follow international accounting standard for the private enterprises. Then we went back to the formula of the basic accounting equation, which is assets are always and always equal to liability plus shareholders' equity. Again, repetition of the retained earnings. From where retained earnings comes? From the opening retained earnings balance plus the net income. So if you have to calculate how much the retained earnings, you have to do two calculations. First calculation is to get the net income. That means you have to get the revenue minus expenses, net income. And then to that net income, you have to add the opening balance and deduct the dividend declared to get the ending retained earnings. If you have to do only net income calculation, you have to do only one calculation, revenue minus expenses. And then we went through those transactions one after another by keeping in mind that we always have to keep this accounting equation in balance. And we went through all those transactions. How many transactions there were? Like 17 transactions. And when we paused the transactions, we saw what happened with cash during the period of 1 month, what happened with assets, what happened with liabilities, what happened with equity. We saw those things last time, if you remember. And once we have, again, keep in mind the assets are always equal to liability plus shareholders' equity. From here, what we did first, we calculated how much is the net income. We start preparing the statements. Net income first, changes of equity second, financial position third, statement of cash flow fourth, notes to financial is the last one. Income, again, calculate the net income by subtracting expenses from the revenue, or revenue minus expenses give you the net income. We get the revenue, put all the expenses, we come up with the net income. Net income, then on the retained earnings and retained earnings only, the balance was zero. We add the net income. deduct the dividend declared, come up with the retained earnings. Then we check the common shares or the capital, the contributed capital from the shareholders. We add those together, and that's gonna give us the balance at January 31st for the changes in equity. Once we prepare that statement, then next step is to prepare the statement of financial position. First, we get the assets, current assets, non-current assets, total assets, and then we get liability, current liability, non-current liability, shareholders' equity. We already know what the shareholders' equity is. Shareholders' equity, we're gonna have only two things, common shares and retained earnings, and we're showing those common shares and retained earnings, and we balance it, and we're done. Statement of cash flow, again, we're not gonna spend time on this. The most important thing is for you to understand is the operating activity is the one of the most important cash flow statement section of the cash flow. Then we have the investing activities, then we go financing activities. Operating plus investing plus financing should give you the change in the cash. What's the change in the cash? We're gonna check on the balance sheet. So since this is the first month of operation of the company, the previous month, the balance was, in the beginning of the month, the balance was zero. At the end of the month, we have $113,200. The question is from where that cash came from. And as you can see here, $8,600 came from the operating activities. For the investing activity, we paid $245,000. So we invested in the equipment and invested in the land. And from the financing activity, from the investors, we get $250,000. From the bank, we borrow $100,000. We pay dividend $400. So in total, we raise capital of $349,600. And that explain the net change in cash of 300, how the cash moved from zero on January 1st all the way to 113,200. Then we can calculate some ratios here, but more ratio we're gonna get next time. Next time in class, we're gonna talk about ratio. That's from chapter 2. Again, from chapter 2, again, the most important things are the same that were important in chapter 1. How to calculate net income and how to calculate the retained earnings. That's what you take. Net income is revenue minus expenses, retained earnings opening plus the net income minus the dividend. That's chapter 2. Now let's move to chapter 3 and finish chapter 3. Sorry, that will be not chapter 3, that will be chapter 4. Let me close those slides that I'm not gonna use. And let's move now to chapter 4. In chapter 4, we started with, now we're gonna explore, and we're gonna explore only one element, one part of the statement of financial position, and that will be the long-term assets and long-term assets only. Why the long-term assets? Because those are the ones that's gonna we're gonna use to generate a revenue in the company. We have different types. One is the property, plant, and equipment, which including all the tangible assets, including land, building, and machinery. Then we're going to have right of use, which is again tangible assets, but those are on the lease. Then we're going to have intangible assets. We're going to have a goodwill, which goodwill I explained to you that happens only and only one corporation buy or try to buy another corporation. And then we have biological assets, which are limited to plants and animals only. And then we check how we're gonna get the value of the different assets. For the property, plant, and equipment, we can use the cost model or we can use the revaluation model. Cost model was the original cost, which original cost is always and always comprised of the cost of the original cost of the asset plus shipping plus delivery plus any taxes which are not refundable. So if you see GST, don't include it in the cost of the asset. If you see provincial taxes, yes, include it. But if you see GST, don't include. Then we're going to have depreciation. And if there's impairment, we're going to show the impairment. So the carrying amount of the asset always going to be original cost minus accumulated amortization up to that point and minus impairment loss, we're going to see a little bit low. So now what's the cost of the capital of the assets that we have to capitalize? Well, that will be again purchase price, non-refundable taxes, legal cost, shipping, transportation, site preparation, installation, setup cost. So if you have some setup cost, you have to be careful which one is the one. So basically, if, for example, I want your opinion on this. I want somebody to answer or post something on the chat room. Let me see what the chat room is so I can see it. So if you have asset, if you purchase a car, and once I purchase the car, in order to drive the car, I have to have insurance. If I buy 1 year insurance, what should I do with that cost? Should I capitalize it, add it to the cost of the asset, or that would be expense? What do you think?
It's an expense. It can be considered as prepaid expense.
Thank you. Thank you. That's exactly what it is. So if you see insurance or some license fees, don't include it in the cost of the asset expense. So let's keep going with our exercise here with the overview of the PowerPoint. We can purchase multiple assets. When we purchase multiple assets for price, we're going to use the proportional method to calculate the percentage and apply it to the amount that we paid. We saw that in class. Then we have the revaluation method. Revaluation method is it doesn't consider the cost now. The revaluation method consider the fair market value of the asset less accumulated depreciation and subsequent impairment loss. So what's the difference? In the first cost method, we instead of fair value, we have a original cost. In the revaluation method, we have the fair value. But once you go that direction, you have to reevaluate annually, every year, or every 3 years. And if you're using this model for the class of asset, then all the assets must be reevaluated. Depreciation. Depreciation was the transferring the cost of the asset over the useful life of the asset into the expense. In order to calculate the depreciation, we need cost, original cost, which original cost, don't forget, is not the purchase price only. You have to include all the other things which are related to the asset to make the asset to be used for the purpose that you purchased the asset. Then once you get the original cost, then you have to find out what's the residual value. Means at the end of the life of the asset, or at the end of the useful life of the asset, can I sell the asset? And if I can sell the asset, how much I can get? And that will be estimated. And the last thing is to estimate the useful life. Now, the useful life can be in years, can be in units of production, and that's pretty much all the options that we have. So how much we have to depreciate? We always have to depreciate only and only cost minus the estimated residual value. That's why the residual value is important. We have three methods. One was the straight line method, the other one is unit of production, the other one is the diminishing balance method. Three methods. On the three methods, we're gonna have exactly the same depreciable amount. The difference will be how we're gonna reach that amount. In the straight line method, we're gonna have the same amount. Once we find depreciable amount in the straight method, the straight line method, we're gonna divide that depreciable amount over the useful life of the asset, and we're gonna add it evenly year after year. If we're using the unit of production, once we calculate depreciable amount, we're going to start depreciating based on the usage of the asset, which can fluctuate. One year can be high, the next year will be low. And the last one is the diminishing method or declining method. That means that depreciable amount in the beginning will be very high and slowly going to start getting down. Objective is with all those three methods, we to reach the same amount. We cannot depreciate more than depreciable amount. And we have to leave the balance waiting for us, which is equal to the residual value. Having that in mind, we're gonna start preparing our schedules. First was based on the company that went buy equipment for $50,000 and has estimated residual value of 5,000. That means we have to depreciate only 45 over the 5 years if we're using the straight line method. So once we get the 5 years, we're gonna see that 9,000 will be per year, and every year we're gonna depreciate only and only 9,000 until we get 45,000 at the end of the year 5. Once we have depreciable total depreciation 45,000, we're gonna see that the carrying amount of the asset will be only 5,000. Unit of production. First, we're gonna calculate how much depreciation we have to apply for every unit that we're producing. In order to do that, again, we have to get the cost. Let's make it bigger here. We have to get the cost first. And then once we get the cost, we're gonna deduct the residual value. That's gonna give you the depreciable amount divided by the total units that you're gonna produce over the life of the machine. And you're gonna get the depreciation per unit. After that, you have to just apply year after year based on the usage. The $2, don't forget the only one thing. You have $2 only and only you using calculation the total number of units, which should be equal to the total number of units that you are actually using the machine. Can you produce more units? Yes, you can. But can I deduct depreciation based on the more units that you are producing? No, you can't. You can only depreciate based on the 22,500 units. That's the only way you can get 45,000 accumulated depreciation as a balance and 5,000 carrying amount. Diminishing method. The first thing that you have to establish is what's the percentage. Determine the depreciation percentage or rate. How are we going to do that? 1 divided by estimated useful life of the machine or the equipment or the asset. Then we're going to apply that rate to the asset carrying amount. And then we're going to start adding the expense or adding the depreciation until we reach the point that we want to reach. So, in this exercise here in the class, you saw that they're using double declining method. So how are we going to get the double declining? First, we're going to check how many years we're going to use the asset. And they say 5 years. So 5 will be our denominator. 1 will be our nominator. And 1 divided by 5, you're going to see that's equal to 20%. And then you're going to double that percentage if you're using double declining. And that's going to be 40%. In the exercise that we did in class, I use triple declining method. So what's interesting here? You start applying that percentage to the original cost of the asset. But objective is you to go only and only to the depreciable amount that you already calculated, which is original cost minus estimated residual value. So you cannot deduct more depreciation than $45,000. Once you reach $45,000, you stop. So on the year, when you see that accumulated depreciation start to exceeding $45,000, you're not deducting the amount that you simply getting from your calculation. You're adjusting at the year that you're exceeding the depreciation. You're going there and adjusting to the balance that you want to reach. If we follow the blind deduct formula, we have to deduct 2,592,000 depreciation. And if we do that, our remaining balance carrying amount will be 3,888. But we already know that we cannot go below 5,000. So how can I go from 6,480 down to 5,000? The only way I have is to depreciate less than the formula shows me. So I'm going to adjust this amount to 1,480, and 6,480 minus 1,480 is going to give me exactly 5,000 here as a carrying amount. And depreciation expense will be exactly $45,000, which I want to be. How are we going to record depreciation? Simply depreciation expense, accumulated depreciation. The only thing that's going to change year from year is the amount here. Then we talk about what's if we have a partial period, if we, whatever it is. So now what you have to keep in mind, if you purchase the asset in the middle of the year, first year you're not gonna have 12 months depreciation, you're gonna have only the amount of the months that you're using the machine. And then you have to add after the 5th year, you have to add again partial year to cover for the remaining months. 15 days rule is applicable for the assets which are purchased between first of the month and the 15th of the month. If that's happened, then you're recording the asset in the current month from the beginning. Then you take in full month. If it's after 15th of the month, then you leave it for the next month. Now, what I personally will suggest you, based on the company, if you work in the small company, once you purchase the asset, leave it for the next month. Start depreciation from the next month. Now, depreciation for the tax purposes, tax per calendar revenue doesn't allow depreciation expense. In fact, calendar revenue tells you how much to deduct as a deduction from your asset for the tax purposes, which is called capital cost allowance. Now, can we have a changes in depreciation method? Yes, we can. If that happens, you have to adjust the amortization schedule to reflect those changes. So if we increase the useful life of the machine from, in this case, I believe they're increasing with another 2 years. First we have 4 years and then they get another 3 years. Then you have to do that additional adjustment. And as you can see, in that case, the depreciation expense is going to go down. Impairment. Impairment is when you sense that there's changes in the recoverable amount. What's the recoverable amount? The recoverable amount is greater than total of all the future cash flow that they expected to generate from the asset and asset fair value less selling cost. So we're checking those two amounts, finding which one is the highest, and then we have to determine, is that amount equal to the carrying amount? If that's not the case, then we're going to have impairment loss. Again, if the recoverable amount is less than the asset carrying cost, this one is not, then we're going to have impairment. For example, let's say the carrying amount is something, let's say 50,000. Then we're going to check the recoverable amount. On the recoverable amount, we're going to calculate the expected future cash flow and the fair value less cost. If the carrying amount is more than the recoverable amount, then we have to adjust it to recoverable amount. But if the recoverable amount is more than the carrying amount, we're not doing anything. So in this case, at the end of the year, carrying amount of the asset is $23,000. Management determined that as a result of the damage of the equipment, the recoverable amount is only $20,000. So here we have carrying amount $23,000. A recoverable amount is $20,000. Now in that case, we have impairment loss. So what we have to do, show the loss right away in the income statement, reduce your income, and create a new contra account to the equipment, which is going to be impairment, accumulated impairment losses. And it's going to look what will be the carrying amount now. The carrying amount will be 50,000 original cost, less 27,000 accumulated depreciation, less 3,000 impairment loss. Carrying amount will be only $20,000. If it was only accumulated depreciation, it would be 23. But that loss that we just recorded reduced the carrying amount to $20,000. What's going to happen when we dispose the property, plant, and equipment? When we dispose the property, plant, and equipment, we have to remove it from our statement of financial position. In order to do that, first, we have to depreciate the asset up to the date of we decide to stop using the asset. Second, we have to remove the asset and related accumulated depreciation from the books. And at that time, we can calculate, is there any gain and loss? So, let's say we're disposing the asset. We're going to get some cash. We're going to remove the asset and we're going to remove the accumulated depreciation altogether. And we're going to check, the money that we're getting, are they more than the carrying amount of the asset? If they're more, we're getting gain. If it's less, we're having loss. Intangible assets. Intangible assets are assets which don't have a physical appearance. How intangible assets going to reflect the statement of financial position? Well, again, they are initially recorded at cost. And then we have to determine whether or not asset has indefinite life or finite life. Which are the type of the intangible assets? We have trademarks, patents, copyrights. We may have trade secrets. But there's no legal registration system in Canada for the trade secrets. Additional type of the assets can be licenses, customer list, franchise rights, computer software development cost. Now, from the research and development cost, since they go together, only for development cost, we may capitalize something. And only if that meet criteria for development cost. If they don't, we're not capitalizing. Intangible assets, they're also subject to amortization now. Now, the tangible are subject to depreciation, intangible to amortization. What we're going to get, again, we need estimated useful life and residual value. Usually the residual value here is 0. And most common method is trend line method. So what we're going to do, estimated useful life divided by number of years. And with journal entry, it again will be similar, amortization expense, accumulated amortization expense. Goodwill. Goodwill, as I said in the classroom, goodwill is only and only when you purchase another business. Two businesses are combined into one. So in that case, you might end up paying more than what you get. If you pay more than what you get, then you're going to have a goodwill. How are we going to determine the goodwill? We're going to get the purchase price, how much we pay. Then we're going to see how much is the fair value of the assets and the liabilities. And if we pay more than the fair value of the assets and liability, we're going to have a goodwill. If we pay less, we're going to have a negative goodwill. How are we going to determine the amount of the carrying amount of the goodwill? The same way we determine the carrying amount of the assets. Since the goodwill asset, we're always going to have a goodwill carrying amount less. In this case, there will be no amortization. We cannot amortize the goodwill, but we can test it for impairment and recording impairment loss. Again, goodwill is not amortized. It's only can be impaired. Right of use assets. Right of use assets, those are, again, assets which are used by the company, controlled by the company. Company is allowed to generate revenue from those assets, but don't belong to the company. So what will be that assets? Well, most of the airlines, they don't purchase the airplanes. They lease the airplanes. In other words, they're renting the airplanes. But since they're renting it for the long period of time, we have a lease, which is the contractual agreement which cannot be broken. Once you rent the airplane, you cannot say, okay, no, I'm not, I can cancel this contract. No, you can't. Those are reported again, we're reporting at the carrying amount, which will be represent again right of use asset less accumulated depreciation. We're also going to calculate depreciation for those assets. Then we're going to the biological assets, which biological assets can be plants or can be animals. Blueberry, raspberry, cranberry, grape, trees, fish, cows, poultry, everything like that. Once harvest, biological assets become agricultural produce and eventually can become inventory. Those are reported always at the fair value less estimating selling cost. Now we're going to the financial statement analysis, which in the financial statement analysis, we have to measure the average age percentage and average age. How are we going to do that? Total accumulated depreciation divided by total property, plant, and equipment minus the land. Why minus the land? Because the land doesn't depreciate. One thing I want you to remember, land doesn't depreciate. There's no depreciation on land. Why? Well, that rock, if you look at north, there's two rocks, they call it lions. Those rocks were there probably 50 million years ago, and they'll be there 15 million years after the humanity disappears. So for that reason, land doesn't depreciate. Average age, that will be the total accumulated depreciation divided by depreciation expense is going to give you the average age of your assets. Do you do you need to know the average age of your assets? Is it important for you to calculate when you see financial statement of the company? Is it important for you to calculate that one? The average age? Yes, it is important because that's going to give you a sense. Is this company going to have ability to generate revenue on the next few years? Obviously, if the average age of your assets is too high, that means your assets are too old. And if you're working in the technology business, and obviously that will not going to be a good investment for the investors, because the only reason that these people want money is to invest. So they're not going to use it. They kind of use it for your operation, but they needed that cash to uh, make a spendings for the new assets. And for the financial, you're going to have the fixed asset turnover, which fixed asset turnover is going to be sales revenue divided by average net property, plant, and equipment. Again, net property, plant, and equipment, you're going to get it as you get the property, plant, and equipment only divided by accumulated amortization. And then you're going to see how much is sales revenue, and you're going to see your fixed asset turnover. Again, we're chasing this only on the tangible assets, which are owned by the company. Remember, we still have rights of use, which is asset used by the company to generate revenue. But in that case, those assets that don't belong to the company, they're under lease. And that's today's chapter.
Yes, professor.
So what's interesting with this question? We have the assets, right? We have the assets. We know the cost of the asset. We have the residual value. We have the useful life. And we have the estimated units that we're producing in total and the first year. So once you start these questions, what do you need first? What was the idea first? First to get the cost, right? And then once we get the cost, we're going to get residual value, if there's any. Once we get those two, cost minus residual value, what's going to give you? You remember?
Depreciation amount.
Depreciable amount. Yes, that's correct. Do we need that depreciable amount?
Oh, what?
Do we need the depreciable amount?
Yes.
Absolutely. Yes, we need it. Right? This is from your slides now. Watch this. From your slides, that's what your slide says. We need depreciable amount is equal to the costs minus the residual value. We need that. What for? To calculate the depreciation expense every period. So once we get the cost minus the estimated residual value, we're going to get depreciable amount. Okay, we got that depreciable amount. How much is that depreciable amount in our case? Here. We're going to have here 42,650. Are you using Excel when you're doing those questions or you're doing by calculator?
Calculate.
Calculator,
Yes.
good.
Yes, we did.
That's you can use
Awesome.
it over. So the other one will be 2,300 here, right? Once I have those two amounts, that will be simple calculation between this one minus that one. So now I know how much I have to depreciate. The question is over how many years and how many units, correct? So what we can do here is I can do it here total years. How many years we have here? 10
10.
years.
10.
Now the question is how much will be per year? Whatever we have to depreciate divided by number of years, correct? Make sense?
Yes.
Then we have units. Let's get the total units. Here we're going to have, let's go here to say total years. Years, and then we're going to have here total units. How many units in total we can produce with this machine?
80,000.
700 units,
700.
right? Right. That's the number of units that we can produce. Now the question is how much is per unit?
40,350
This
divided
one
to, yes,
divided by number of units, right?
total units.
So that will magically is going to be 50 cents per unit, which is exactly the round number. So that's how much we have to depreciate every time when one unit is produced. And every year we have to depreciate that one, correct? So if you're using the straight line method, over 10 years, can we prepare the amortization schedule? Yes, we can. What do we need? Year 1, year 2, and all the way to year 10, right? That will be year 10 here. We have 10 years. What we're going to have? We're going to have our beginning balance. Then we're going to have depreciation expense. Let's add one line. Then we're going to have accumulated depreciation. Next thing that we're going to have is the ending balance, right? Remember from the class? And what we're going to do, we're just going to start plugging the numbers. What's our starting point? What's the beginning balance before the amortization, depreciation the first year? Will be cost, original cost.
42, yeah.
Always going to be cost. How much is my depreciation expense every year? Every year will be that amount. Is that going to change? No. So I can easily drag this amount all the way for 10 years. And after 10 years, how much will be my total depreciation?
43.
40,350.
40,350. After year 10, what should be my ending balance here?
2,300.
2,300. That's my objective now. Now the question is, can I reach those objectives? Well, I should be able to reach it. So accumulated depreciation first year will be equal to the first year. Ending balance will be equal to the beginning balance minus depreciation expense for the year. And we're going to get the ending balance. So what's happened now? The ending balance is the beginning balance. The ending balance. Beginning or beginning balance is the ending. We get the Then we're going to get this amount, depreciation per year. The cumulated depreciation, the second will be this amount plus that amount. It's going to double. And then my ending balance will be beginning balance minus depreciation expense per year. Then what they have to do, the only thing they have to do is drag this down, get those two, drag them down, and I'm going to get my amortization schedule. So now I know every year ending balance, that will be the carrying value of the asset, and that's how much going to stay on the balance sheet. That will be the amount that's going to stay on the balance sheet every year. Right? So if you want to make it nice, we can put some here, some net. And that will be the carrying amount, accumulated amortization every period. That will be our depreciation expense. As you can see, that doesn't change, stays the same amount year after year. And our beginning balance is the beginning balance. And now we have a perfect amortization schedule. Number of years, let's put another cover here, make it more colorful for the students so they can like it. And there we go. At the end of the day, what we have to remember, our accumulated depreciation always going to be the one that we want to depreciate. And those two amounts always going to be equal to the carrying amount, always. Original cost. How this going to change if we're using unit of production? Not dramatically. Let's go with the next one with the unit of production now. That was for that one, but let's get this information, cut it from here, paste it here, and we can start using it. The first year, what do we need? We need to add one column here. What will be our column? Our column will be, we want to move it, all right, like this. So my column here will have to have a new column, which new column is going to be called units produced. Used, like you say, used. So what will be my beginning balance? Let's delete everything. But the whole point is we know what will be my can I no, I don't want this one. Let's copy this and move it here as well. So I don't have to go too far. And so what do I know? I know how much should be my depreciation expense. 40,350. My total accumulated depreciation should be equal to exactly the same amount. My ending balance after you use this machine, for how many units we're going to use it? How many units should be equal here, the total? Do I know that number?
80,700.
80,700 should be my total here. If I get more than that, I cannot go over. So beginning balance, we already know. Beginning balance is your cost, always. How many units we produce the first year? Units.
5,100.
Units. Year one, we use 5,100. Not this one, right here. 5,100. So units first year, 5,100. How much will be the depreciation? Now I have to, if you want, you can add here one line. Let's put one line here. Don't worry, I'm going to give you this Excel spreadsheet after the class. Let's push it down. And here depreciation expense per unit is 0.50 cents. And once I get that, that will be equal to 5,100 times 50 cents. Accumulated depreciation obviously will be the same amount, and the carrying amount the first year will be original cost minus depreciation expense. Now, the only thing that I need is to plug more numbers here. Once I get more numbers here, I'm going to get the information here. Now, let's pretend that we know this information. Let's play with this information here. I'm going to copy this and I'm going to paste it right here. Let's label it. That will be the striped. That will be our straight line method. This one will be unit of production. Activity here, they call it. Team method. And what method left?
Double
Declining method, right? So now is it going to be double or triple? It depends, right? But let's put it declining. Do you want to do the declining method just for the sake of practice?
Yes.
Yes, sir.
Okay, let's do that. What do we need? I have to get rid of this. But remember, whatever you're doing, you know that in the very beginning, You know your objectives. What are my objectives here? To get the ending carrying value equal to the residual value, and to get my accumulated depreciation to be equal to exactly the depreciable amount. Because that's the only way I can get the original cost. So I'm depreciating only the depreciable amount, nothing more, nothing less. And the beginning balance is always and always original cost. So once you have this in mind, what we have to do is to get the percentage. How are we going to get the percentage?
1 divided by
Equal to 1 divided by number of years, 10. So what's the percentage per year? 10%. So what we have to do now, we have to either double it, either triple it, right? Which method we're using? Double? Let's go with double. Time 2. How much will be the percentage of using depreciation percentage will be equal to 10 times 2, correct? So we're going to use 20%. So in this case, what we're going to have, let's add here a new column. And let's change the color. And that will be the depreciation percentage. And that percentage is always and always will be 20.
Sorry, Professor, could you
Yes,
please explain the rate again, the depreciation rate, how we calculate this?
percentage per year.
Yes, percentage
Percentage
per
per
year.
year will gonna be equal to, let me put here the formula, equal to 1 divided by
years.
percentage per year. Percentage per year. In this case, is equal to 10 years. No, sorry, 1 divided by the number of years. Number of years. In this case, 10 years. That's how we're getting it. Make sense?
Yes, and we just need to double the
Yes.
percentage, whatever we have.
If it's double, 2.
Okay,
And then you're calculating depreciation
okay, thank you.
percentage.
Sorry, I have a question.
Yes, please.
The question say to us we should calculate it in double or triple.
Yes, the calculation is gonna the question is gonna
The
tell you which
question.
method.
Uh-huh.
Yes, the question is
Okay,
the one
thank you.
that's gonna lead in, right?
Thank you.
Yes. So once you say 20%, I can drag this 20% all the way to the end. How this percentage is gonna change? No, it's gonna change, right? It's gonna stay the same. Always 20%. Now
Yeah.
depreciation expense will be the beginning balance times the percentage. We have the first year. And then my accumulated will be whatever we get the first year. My carrying value is going to be equal to this one time minus, sorry, not time minus, it should be minus the depreciation expense for the year. Next year, beginning balance is my ending balance. Again, I'm calculating based on the 20%. Now my accumulated depreciation will be the first year plus the second year. And then I'm going to the carrying value equal to the beginning balance minus depreciation expense for the year. Now I can drag down the formulas and see what's going to happen. Am I going to be okay all the way to the end? Do we have to make any
No.
adjustments?
Yes.
Yes? No?
No.
No.
Something. No, 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 no.
No. We're not exceeding, you see, on the year 10, our carrying value, it's not below, doesn't drop below the residual value. So we're okay in this case. So let's make it interesting. Let's triple it. Make sense?
Yes.
Otherwise, there's no usage of this calculation. Let's triple it. And let's see if what's gonna happen if we triple this one. How are we gonna triple it? Instead of double, it's gonna be triple, right?
It's 13%.
3. Now we're gonna have 30%. What's gonna change? Here, the percentage is gonna change. That's gonna be equal now to this amount. And let's log this cell, F4. And we're gonna drag it down. How about in this case? Do we have a problem?
In the year 9, we have, I think, problem.
In here, we're going over,
Yeah.
right? So what do we have to do?
Yes.
Delete year 9 and delete the depreciation expense. What do we know? That we know that here we have to have $2,300. And that's the only way
And can we use
can.
Excel in the test, the quiz?
On the quiz, can you use the Excel? No, only
No.
calculator. But you don't have to do this complex calculation. Don't worry about it. On the quiz, you don't have to prepare schedules, anything like that.
Uh-huh.
So on the last year, what you have to do? Get the balance that you need and do the calculation. The balance that I need minus the previous year balance. Ah, that's not the one. No, the opposite one. Should be the opposite calculation. Should be equal to the balance that I have minus the balance that I need. And it's gonna give you the depreciation. And the last year, no depreciation. So basically, for those 2 years, you're making a manual adjustment. Only for those 2 years.
Yes.
And that's how you're getting it. Now, if you want to quadruple it, what's gonna happen? We're gonna amortize it, depreciate it faster. Right, that will be your question. What was the question 7, I believe?
Professor,
Yes.
from the declining method, the table above
This
this one, yes.
Yeah.
After 10 years, that the annual balance that over 4,000,
Yes.
it not like 2,300. So
No,
we don't have to adjust.
no, we don't have to adjust it.
Mm,
We don't have to do anything. If it doesn't reach the depreciation, that's fine. Totally fine. You don't have to do anything. The question is don't go above. You can stay below. That's fine.
yes, because at the beginning of the at the time that we purchased the machine, for example, that like we estimate the residual value,
Yes.
and if we do the method, for example, and the residual value after 10 years is different, is it okay?
Yes.
Uh,
In this case, it's okay. In this is okay. So so what you have to do, you as a manager, if you see that actually happened, that means you still have higher value than what you're expecting. So what you have to do, go here and adjust the percentage. That means the 20% is not going to be enough you to, based on the declining balance, the
Yes.
20% is not going to be enough you to amortize the asset.
Mm,
So what do you have to do? Increase the percentage,
okay, got it.
right? Increase the percentage. Once you see something like that happen, increase the percentage. Go with the triple. So on the triple, yeah, you're going to achieve the objective at year 9,
Yes.
which is way better than leaving here high balance than this.
Okay, thank you.
Now, if it's highly sensitive asset, based on there was a question that says you working with a very technology sensitive asset, what you gonna do? I'm gonna here go with 5, right? Let's not go here, but let's go here. Yeah, I'm gonna go here with 5. If I go with 5 at year 4, I already depreciate my asset, right? Actually, at year 5. At year 5, I'm exceeding 2,300. At year 5, I'm gonna make adjustments. So the last 1, 2, 3, 4, 5 years, there's no depreciation. But that's only and only if you're dealing with something very highly sensitive to technology. Let's say you're dealing with this, I told you, with the gamer computer, but yeah, something like that. So you expect the useful, but obviously the useful life is not going to be 10 years, it's going to be less. Make sense? Then based on the asset, you have to do those adjustments. But here we're talking about the machinery, which is producing the units of output. So that's the thing. The previous question was building, right? The building. On the building, obviously, the straight line method will be the most appropriate. Why? Because building is a kind of a steady asset. Double declining method for the building, it just doesn't make sense. Right. Okay, so let's keep going with the next question. So we can cover all the questions from your side. I'm sorry, I used this question to show you all the 3 methods. So now I don't have to show you all the 3 methods. Even though I do have to show you those 3 methods because question 9 is talking about the 3 methods. But now we can use the table. That's the beauty now. Once you have the tables, we just move the tables here and I'm gonna flip the question. Just give me a second to make adjustments. That's the question, machinery, for it's expected from here. It's expected this. The machinery is expected this. Produced component, the company. Cut and here. So no. Let's put this one here and let's get this one. Components. So we have all the information, correct? What they have to delete, they have to change this, they have to change this, they have to change this, and we can delete in this entire information. We don't need it at this point. The question asks you here, the straight line method depreciation per year, unit depreciation per unit and per year, and the rate that you can use, and depreciation per year. Let's go one after another. First line, straight line method. What do we know, what we don't know? What we have to fill? We have to fill those gaps. What's the first? Do I know the cost? Can you guys see my screen?
Yes, sir.
Can you see the question?
Yes.
Professor.
Yes, sir.
Okay, so let's go one after another. What's the cost?
It's
1,300,000.
103.
Yeah.
103. 1, 2, 3. Is there residual value?
10,000.
10,000. So how much we have to depreciate?
93,000.
Okay. How many years?
4 years.
4 years. How much will be per year now? 93,000 divided by 4.
4. 4.
Okay, so that will be equal to 93,000 divided by 4. We get our amortization per year. What's our objective? How much should be my total depreciation expense?
93,000.
93,000.
93,000. How much should be my accumulated amortization? Same, 93,000, right?
93,000.
How much should be my residual value or carrying value at the end?
10,000.
10,000.
10,000. So that's what we know. So that's the only way you can get 103,000 beginning balance. So beginning balance is our cost.
102. Yeah.
Depreciation expense. Every year will be the
23.
same, right?
Yes.
How that gonna change year per year? Not gonna change. So I can easily log this cell and just drag it down, and every year after year is gonna be that. And the total, did I get 93? I'm getting
It
more.
should be, yeah.
Yes.
No, I'm getting way more, people. Why? Because
Because it's for a
it's
year.
wrong here. We have to change here for how many years? 4 years.
4 year, yeah. It's
Our
10 years.
amortization schedule here is for 10 years. So
Yeah.
we have to get rid of some years, right? Let's get rid of those years. Up. That will be the one. That's what we need, right? Year 1, 2,
Yeah.
3, 4. So let's put the actual years, because we have 2024, 2025, 26, 27, correct?
Yes.
Those are our years. Let's delete those 1, 2, so make them even. No. Let's get rid of this, otherwise this is gonna bother us. Let's get rid of this. For now. Later on, we're gonna bring it again. So, okay, so we get 23. 23, 23, 23, 4 years, 93,000. We're good. We get what we wanted. Accumulated depreciation, first year. It will be the same. Carrying amount will be the beginning balance minus amortization
Depreciation.
expense. Right. Next year. Beginning balance is the ending balance. Depreciation, we already have it. Accumulated depreciation should be equal to first year plus second year. And the ending balance is beginning balance minus the depreciation expense. And once we drag it down, did we get what we wanted? We get what we wanted, right?
Yes.
So you have the depreciation expense per year. That's the first part of the question. Now let's do this for the second part of the question. Now, let's build it from scratch. Let's not using this. I'm gonna delete this. And then I'm gonna add it again. Let's go now units of production. What do we need for this unit of production? Pretty much the same thing, right? Let's copy this and paste it here. Cost is the same, right? Residual value is the same, same asset, everything. What do we need here? Total
Your total units.
units produced. How many units we're gonna produce?
200,000.
We're gonna produce 200,000. Okay. So if we produce 200,000, how much will be the depreciation per unit? Do you know how much I have to depreciate?
0.94.
I have to depreciate 93,000 over 200,000 units. So that's gonna give me divided by 2000 is going to give me 47 cents per unit, correct? Are you guys with me?
Yes, sir.
Yes.
Yes, sir.
Okay, so now I have to change these numbers, right? So what do I need? I need, let me put those one in the middle, this one in the middle. And what do I need? I need the beginning balance. Do I know my beginning balance?
The cost.
Cost is my beginning balance. Now, in order to get the depreciation expense, I have to add column here, right? Insert. Right, let's add the column. What will be my column here?
Unit used.
Units production. Depreciation per unit. No, units used. Yes, you're right. Units used. Do I know how many units I'm using first year?
40,000.
40,000 units first. 40? Yes, 40,000. Second year,
50,000,
50,000.
60,000, and 50,000.
60,000 and 50,000. That's too much. 60,000 and 50,000. Okay. How many units I use it?
200,000.
Can I use it more than 200,000 units? Technically, I can, but no depreciation, right? That's the key here. So, can I use it in the last year? Can I use 52,000 units to calculate my depreciation?
No, it's
No,
above that.
No.
it's above. So you have to be exactly 200,000. So those two numbers have to match. So depreciation expense will be that amount per unit. So every time when I use 1 unit, I have to apply that amount. And let's log this amount so that sales doesn't change. And my accumulated amortization will be that much. And the carrying value will be the beginning balance minus the depreciation for the year. Beginning balance next year will be the ending balance of the previous.
Ending balance. Yeah.
Depreciation expense, we're using the same. Accumulated depreciation will be this amount plus current year. Carrying amount will be beginning balance minus
Divide minus.
depreciation per the year. And now I can drag the formulas and see what's gonna happen. Did we get what we wanted?
Yes, sir.
Yes. So do I know how much my depreciation every year?
Yes.
Yes. Okay, this one is done. Next one. What do we have to use for the next one? The
The
next one, double. Let's see what the question is. Double diminishing balance method. Let's do the double diminishing balance method. Too many lines here. Let's get rid of those one and use only the name here. We're not going to use anything else. I don't need anything else. Double declining method. Let's stretch this one. Okay. Yes. And that will be double. So for double declining method, what do I need? I need pretty much this information here, right? So let's copy this information. And let's move it here. So for the double declining, we don't need this one. We have to start from scratch. I need the percentage, right?
Yes, sir.
Let's put this percentage. That will be depreciation. The percentage. And now we have to calculate that percentage. How are we going to calculate the percentage? We have the cost, we have the residual value, we have depreciable amount. Let's go with the percentage now. How are we going to get the percentage that we need?
1 divided 4.
What will be that? That will be depreciation percentage.
25%.
Percentage is going to be equal to 1 divided by number of years, which in this case is 4, right? So it's going to be equal to 1 divided by 4. How much is that?
25.
25%. So what we have to do? We have to double it.
Double.
That means 2. So that will be for depreciation per year now. It's going to be 25 times 2. It's going to be 50%. Make sense? So that will be our depreciation percentage, 50% here. And let's log this cell because it's going to stay the same. It's going to be, oops, that's not what I wanted. %50 per year. Do I know my beginning balance?
Yes.
Yes. 103. And then start calculation. First year depreciation, 103 times 50%. Accumulated depreciation first year, the same. Getting value, beginning balance minus the depreciation expense. Next year, ending balance my beginning balance. I'm still going to apply 50% times 50%. Then I'm going to have accumulated depreciation will be the first year plus second year. Carrying amount will be beginning balance minus depreciation expense. And now I can drag the formulas. Do I have a problem?
Yes.
Yes.
Yes, I have a problem. On which year I have my problem?
2027.
2027. 2027 year 2027 is my problem. So what do I have to do? I already know. Can I have below 10,000? No, right? And the balance has to be 10,000. So I can override this 10,000 myself. So what will be my depreciation expense here? That's from 12,875 is going to bring me to 10,000.
2,875.
2,875. Now, did I get what I wanted?
Yes.
Yes. Make sense?
Mm.
Now, what's the intake from this question? You're always going to get what you wanted. The question is, what do you want? Okay, that's question 9. Now let's quickly check question 10, and I'm gonna let you go. That's a good question. That's a very good question now. You're gonna purchase different things, and then you have to figure out which one is what, right?
Yes.
That's interesting question. Let me stop sharing for a second because I need to do some adjustments on the Excel spreadsheet here, and then I'm gonna share it again. Perfect. It works.
And where can we access to this Excel
Sorry,
file? Where can we access to this Excel file?
you can't. I have to post it. But I'm gonna post it
In,
after we're done.
okay, in Brightspace, yeah?
Right.
Yeah, okay, thank you.
That is correct. Okay, almost there. Just give me a sec. All right, let's start one after another. I'm ready. Let's make it a little bit bigger so you can see it, and there you go. What I'm sharing here, not this one. I wanted to share something else. This one. Here we go. Can you see my screen?
Yeah.
Okay. So let's go one after another. Acquisition of land to be used for the building site. What is this? Is it asset?
Debited to land, but
But first, is it asset?
yes,
Yes. What kind of asset is?
long term.
Land.
Land. So drop it down, choose land, and move on. Next one. Demolishing of the small buildings on the land to make the way of the new building.
Land.
Is that asset?
Yes.
Yes.
To which asset can I use the land if I don't demolish this building?
No.
No,
No.
No.
So
you have to
is
like
it
create.
is it the big cost of the land?
Yes.
Yeah.
Yes. Cost of the land. Okay. Next one. Leveling the land to prepare for construction of the new building. Question. If I don't level the land, can I use the land to build the building?
No.
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 Is it asset then?
Yes.
Yes. What kind of asset is?
Land improvement.
Land. So at this point, what's the cost of the land? All those three. Make sense?
Yes.
This is the cost of the land now. Okay, next one. Construction of the new building. What's that?
Building.
Building. That's a building. No questions about it. Paving of parking lot beside the building. Is this part of the building?
Land improvement.
Land improvement.
Land improvement, right? So improving the land in order to have access to the building. But it's not part of the building. It's not part of the land. It's something different. Land improvement, okay? Next one. Adding a decorative landscape around the building, such as planting flowers and ornaments, shrubs. What are we gonna do with this?
Land improvement.
That will be one way, land improvement. Or the other option might be expense, right? Let's see what kind of options we have.
Yeah, expenses or land improvement.
One of those. We don't have land improvement here as option, right? We have either expense, either land improvement. Next one.
Professor,
Yes.
yeah, that's the one that I confused.
Yeah,
Like,
but once you drop down the options, do I have land improvement?
yeah, but why we have the option here like expand or land improvement? I know that from
Because
the
different people. So listen, it's $6,000. $6,000. Different people, different managers gonna treat it different way. I personally gonna treat it as expense because of planting flowers. How long those flowers gonna last me? 1 year? I don't think so. Or shrubs. What if those shrubs died in 6 months? Or the plant when I put the flower, planting the flowers, the crows gonna come and eat the seeds. You see, different people gonna treat it different way. Some people can treat it as a land improvement, which yes, it is land improvement, but then 6,000, we're spending 6,000. That's depends size of the company. If they're spending $290,000 on the building, 6,000 on the landscaping around the building, probably I'm gonna treat it as expense.
so for example, for the generation number 5, that paving a parking lot
Yes.
beside the building, so it could be considered as expand or land improvement as well,
Hold on a
or
second.
not?
Hold on a second. Now, paving, for how long is gonna be that paving last? First, do we have low option expense land improvement? Yes, I do have option. But the question here is with the paving, how long is gonna last me? How often you paving the parking lot?
Or 6 months, I don't know.
Really? Every 6 months you're gonna put a new surface on the parking lot?
Maybe in Vietnam, I don't know. Yeah.
So you're telling me you're telling me that parking lots in Canada, they changing the surface every 6 months?
No.
No. Every 2 years?
Maybe 5 years, Professor?
Or maybe more. It's a parking lot at the end of the day. There's no huge traffic of the cars there. Make sense? Do you understand this? Yes, if it's a road, yes, there will be kind of 5 years or 10 years or something like that. But when it's the parking lot, it just cars just coming and parking, coming and parking, coming and parking, nothing more. What are the chances I to change the surface every next 10 years?
Okay.
Make sense?
Yes.
But is this improve the land? Yes. Is that makes access to the building? Yes. Do I need that parking lot? Yes, I need it. That's how you should look at this. With the landscaping and the planting the flowers, I may have to plant those flowers to next year again. Now let's go with the purchase of a new piece of equipment. What
It's
will be that?
equipment.
That will be equipment, no questions about it.
Improvement.
Now, how about the sales taxes?
Equipment too.
Which one? If I can recover it as a GST, do I have to put it a part of the equipment?
No, not that.
No.
Effect.
So in that case, those they say expenses shouldn't be expense at all, but there is no effect. There should be no effect here. Do I have no effect as option?
Yeah, we have. Yeah,
No
we
effect.
have. We have.
That will be no effect because it's not expense. Remember, GST is not expense. You're gonna get the money back from the government, so you're not losing the $6,000. But if you cannot get it back from the government, that will be part of the equipment. And then what will be the value of the equipment? $86,000. How about the installation of the new equipment? Can I use the equipment if I don't install it?
No.
No. So is it part of the equipment?
Yes.
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 How about the testing and adjustment of the new equipment? Do I have to test it
Yes.
before I use it? Can I use it?
Equipment.
Can I use the equipment if I don't test the equipment?
No.
No.
It's
So
equipment.
it's a part of the equipment, right?
Equipment.
So now, how much is the cost of the equipment if we have a GST? So how much will be the cost of the equipment if I have GST? It's going to be 80 plus 3 plus 1.5. Make sense?
Yeah, all the equipment.
Right. If I pay some other taxes which are not recoverable, then I'm going to include the 6,000. Make sense?
Yes.
Okay. How about minor repair on some old equipment? What will be that?
Expense.
Expense. Why? Because it's a repair. It doesn't change the life of the equipment, just expense. Minor overhaul on the old piece of equipment, extending its useful life by 3 years.
Equipment.
Equipment.
Why?
Because it's increasing the life.
Because extending the useful life. Then we're going to be equipment. Yes. Routine maintenance of the equipment.
Expense.
Expense. Replacement of window of the broker broken by this employee during the labor dispute.
Expense.
Expense.
Okay, that's expense. Make sense?
Yes.
Professor,
Yes.
why is leveling the land to prepare for its construction of the new building a land and not land improvement?
Question. Can I improve the land if I don't have the land available for use?
No.
No. Do I need to level the land in order to use it for the new building?
Yes.
Yes. Once I level the land, that's how it's gonna stay.
Yes.
It's kind of questionable, right? Because now you have to start building a building, right?
Yeah.
Make sense? So
Yeah.
again, the question you should ask yourself is, if I don't level the land, can I use the land?
No.
No. So is it separate from the land?
No.
No. So for example, if I put fencing around the land to prevent people not trespassing, is that improve the land?
No.
No. So what will be that now?
Land.
Land improvements. It's not
Land
going to be,
improvement.
that will be land improvement because it's not for the land, right? The fence around the land prevent the people not to cross to the land. It's not caused directly to the land because you're not doing anything on the land. There's no activity on the land. You're just protecting the land from the people trespassing. Make sense?
Yes, like I can still use the land if it's not fenced, right?
It's a land improvement now,
Okay.
right? How about if I put lighting around the land?
Land
Is this part
improvement.
land improvement? Make sense?
Yeah.
Okay.
Thank you.
Good job, people. So I'm gonna post this one. Just stay with me. If you want to see it, I'm gonna post this one somewhere and you can use it for your purposes. Let me save it first somewhere on my computer and then I can post it for you. Let me stop sharing this one first.
Thank you, Professor.